Hey everybody, we're going to let a few more people come in. I'm sure they're busy celebrating happy hour, May the 4th day. Be with them, Star Wars Day. So, yeah, you're going to see some interesting backgrounds. And as you guys know, Rob, who's up here, likes to take liberty with his extremely right-sided brain. So it's possible that Doug and myself make a couple cameo appearances in this slideshow. You guys probably didn't know that we were actually professional actors. We both started doing this during COVID since we had a little extra time. Um, but anyway, hope you enjoy the pictures and hopefully it doesn't detract from the actual information we're trying to get out. Rob got excited with some of these pictures. But so
I'm
yeah, we're gonna have Doug on and his partner Jeremy. Both are with Greysteel, and I'll probably be asking them to interject on a few questions and some points, and then please do a couple things as you guys are listening in. One, highly recommend you put your contact information in, not for us, but for anybody else who may want to reach out to you. For many of you, you guys do 506B syndications, and this is a great way to at least start that pre-existing business relationship. So I'd highly recommend that. And then Jeff will be following all of the questions in the chat room. So please feel free to ask questions. Jeremy and Doug love questions. The last time I was on a conference call with Jeremy, I think he had thousands of questions, if I'm not mistaken. Right, Jeremy? Jeremy's on mute, but that's okay.
Yeah, Merrill. Sorry, that's absolutely right. I can't hold them in sometimes, so let's keep them coming.
Yeah, you love the questions out of Austin. So let a few more people come in. Hope everybody's having a good day. We are planning on doing an actual happy hour again in the next 4 or 5 weeks. I apologize for those of you that don't live in DFW. It's been fun, and we'll continue to do these as well. But we do miss some of the actual face-to-face. It's great for marketing, but we are gonna continue doing this. But we've been getting a lot of pressure to go back. And for those of you that are outside of Texas, I don't know where your COVID vaccinations are, but Texas is wide open right now. Matter of fact, it seems, unless I'm mistaken, it seems busier now than it was pre-COVID. Maybe it's just because everybody's trying to get out. So that's good and bad, but still be careful. I have two very close friends who had pretty much the same level of COVID that I did and my wife did. And he just got out of the hospital about 2 weeks ago, went through the exact same thing. So it's still there. And ironically, he tested positive the day after his first vaccination. The vaccination didn't give it to him, but that's just when he tested positive. So I think, Jeff, you're admitting everybody. And we've got Cindy and Greg. Cindy's partner with me in the law firm. Greg is our senior associate in the law firm. So that means Greg does all the work, Cindy reviews it, and I just, well, I can't say I play on my boat because my wife made me sell it during COVID. It's a whole nother story. So tonight, we are talking about preferred equity, a lot different than private equity. I've had a very brief discussion on this in the past. Cindy and I and Greg have had a brief webinar on this in the past, probably about 6 months ago. And since then, we've had a large increase in our clients utilizing preferred equity. I myself am in 4 deals that have utilized preferred equity. And so I understand it. I respect when the right time is to use it, and quite honestly, when the right time is not to use it. And I'm fortunate to be able to have Doug and Jeremy that'll be able to chime in a little bit later. Doug can tell you, not specifically, but many of his or some of his clients on the brokerage side that may be utilizing preferred equity. And then Jeremy is the guy at Greysteel, or one of the guys at Greysteel, that actually works with all types of capital beyond debt. So should be an expert in as well. So I'm going to go ahead and start this. Let me squeeze you guys down to just one view. There we go. So I can actually read what I'm doing. So as you can see, Rob put Doug in I think that's Han Solo, and I don't know why I'm Obi-Wan Kenobi, but whatever. Let's see. Again, just put a little funny quote from Yoda. Try not, do or do not. There is no try. Yoda, do what you want with the quote. We're forecasting Doug on the Death Star. Hopefully that is no reflection of what ultimately may happen with Doug's career, but I think he's going to do just fine. I don't know why Rob put him on the Death Star. All right, so Yoda's going to tell us what is private equity in a nutshell. Private equity is ownership or interest in an entity that is typically not a publicly listed or traded entity. I'm sorry, it says private equity, it's supposed to be preferred equity. The preferred equity industry is comprised of institutional investors such as pension funds, large preferred equity firms funded by accredited investors. There are also family offices that have created their own preferred equity funds. So we're seeing more and more of them, and we're seeing more and more of them dip down into, I refer to our kind of area as mom and pop, or I would just say non-institutional investors. So we're going to talk about some of these opportunities. So when is preferred equity used? Typically, it's used to reduce the cost of capital or the capital stack, which we'll go into detail in a minute. But just generally speaking, capital stack is the cost of your capital. Debt is included as part of your capital stack. So if you're running at 70% debt and you have 30% private capital, which is your capital raise, if you're paying out a 20% IRR on the 30% and you're getting debt at 3% on the 70%, you average those pro rata, and that's going to give you your cost of your capital stack. So the idea with preferred equity is instead of 30% private capital, you cut that in half in many scenarios if you have 70% debt. And so 15% of that 30, or half of it, comes in as preferred equity. And typically that's going to come in at somewhere in the range of 12 to 17 or 18%, depending on the asset, depending on the sponsors. Regardless, it's coming at a number that's less or significantly less than the private capital. So it's going to blended reduce the cost of your total capital, and that translates into more money for your LPs and more money for the GP. I just kind of went through number two. Three, it's utilized like mezzanine financing. I don't know how many people are familiar with mezz finance, but mezz is typically a second lien position, higher rate. It's utilized in a lot of institutional transactions, and is utilized on some multifamily transactions, but most of my clients or our clients at the law firm are not utilizing mezz. They're typically much larger deals. But the difference is this is not financing. It is actually an equity interest. It looks like, it's funny, it looks like mezz, smells like mezz, but it's not mezz. It's an equity interest. And one thing we'll go over a little bit with Jeremy and Doug, but basically what we have found and what we've seen as the law firm and personally experienced, the sooner that you bring pref equity in to a syndication, typically the more favorable the terms are. You rush them, you go down to the wire. There's not going to be a whole lot of negotiation. There's not going to be any way to shop it. So as we'll talk about shortly, if you're going to utilize pref equity, it's more often more advantageous to try to utilize it towards the beginning of the transaction, or at least once you've finished out your due diligence period. So Millennium Falcon, for those of you that don't know, this is a kind of a version of a capital stack. Obviously, not every agency or conventional loan or bridge loan is at 70%. Some may be at 60, 65, 70, 75. It just depends. This is just a sample. And it's just to show everybody kind of how it lines up. And so when I was talking earlier about your capital stack, how you blend it, as you can see in this example, I'll use my mouse, the top piece, common equity, this is your private capital you're going to raise. And so that's, if you're looking at the deals that are out there right now, people are typically, or sponsors are typically offering an estimated 18 to 20% IRR to the top. And then Your agency and conventional debt, I put 3 to 5%. 5 is obviously on the high side. 3 is on the low side. So it's somewhere between 3.5. If you go bridge, it might be a little bit higher. Jeremy can probably speak to that if we want to talk about that later. But you see where preferred equity comes in. Preferred equity comes in this scenario, I use 12 to 16%. Occasionally you'll get less than 12, but typically what we've seen is most of the preferred equity is coming in around 13.5, 14. And I'll explain, and we'll go over in detail in a minute, how that breaks down. But clearly there's a difference between 12% and 18, or even 16% and 22. That 6% is going to translate into a better return for your common equity and a better return for your GP if it's utilized in the right circumstances. And this is something that everybody should know. It becomes a little confusing for those that haven't done a preferred equity piece in their deal. So the deal is going to be structured a little differently. Typically in the deal, you're going to create your fund. I call it 123 Main Street Fund. And in that fund, you're going to raise your capital. You're going to raise your capital. In a normal deal, this would be 30% common equity capital, and the debt would be 70%, using the same example. Instead of it going here, it would go straight here. However, when you're doing preferred equity, every deal that we have represented and the deals that I am in have a different structure. So you have your asset up here, and then what you do is you create a single purpose entity right here. This single purpose entity is comprised of 2 members. Your pref equity fund, that would be the pref equity group that's providing 15% capital in this scenario. And the second is going to be the actual fund that the sponsors created. And your private capital, or the capital they raise, is going to come in here to the fund and then flow up here to, I call it 123 Main Street LLC. That 15% flows up here, and then the debtor is going to provide 70% to buy the asset. So they have this sitting up here, and as I'll go over later, this is where MEZ becomes more exciting to pref equity. MEZ becomes less exciting, to pref equity investors, because this is actually an ownership interest. And if you have an ownership interest in a multifamily right now, what do you get? You get tax advantages, the accelerated bonus depreciation. Not every pref equity fund, and quite honestly, most don't really care about the accelerated bonus depreciation. However, it is able to get their percentage, their pro rata percentage of accelerated bonus depreciation should they want it. Most of the deals I have seen, the pref equity have foregone that, and Jeremy can speak on that kind of towards the end. But again, this is not a loan. It looks like a loan, it smells like a loan, but it is not a loan. It's very close to a loan. So this is the typical structure. It'll cost you a few extra dollars. We're going to go over some of the fees a little bit later, because another entity has to be created here, and you're going to pay for the pref equities law firm to create the entity and create the company agreement that sits up here. So what I wanted to do, again, there's Doug. Actually, it's pretty funny. Doug always wears sweater vests, and we actually have a vest right here. Just so happened that Han Solo was wearing the same outfit as Doug. So we're very fortunate to see that Doug's cracking up. So I'm going to go over an example, and I apologize. It's not lawyer math. If I was a lawyer, I probably could have made this much, much easier, but I wanted people to be able to see how pref equity works in a deal at a very high level. It's still a high level. So I created this very simple, in my mind, simple spreadsheet, but I'm going to break it down in pieces so you can kind of see how it works. So I have no idea which deal this is. I don't even think it's in Texas, but I just found a nice picture on Google. So let's assume the total capital required for this is 30 million. So the total cost of this project is 30 million. So pref equity will come in right after debt, as we just discussed. Here's your debt. So I'm showing you guys 3 different scenarios because I've seen all 3 of these scenarios currently on deals. Let's assume bank debt's at 3%. That's about right. It may be a tad bit higher, tad bit lower, depending on the market you're in. But let's assume it's 3%, okay? And in these 3 scenarios, one asset's going to get 65% debt, one's going to get 70, one's going to get 75. Pretty easy to follow. Typically, some pref equity funds are different, but typically pref equity will go all the way up to 85%. And when I say go up to 85%, that's bank debt plus what pref equity is putting in equals 85% of the cost of the project. Okay. So typically they'll go up to 85 if there is, if pref determines that there's more risk in the asset and or the sponsor, they may opt to only go up to 80% or 82.5. And I have seen one at 87.5, but I'm using 85 because that's kind of the typical area that it sits at. So obviously in a 65% deal where the lender is only providing 65% debt, pref equity would fund 20. And I'm using the cost of pref equity, kind of an average of what I've seen of 13.5%. Okay. And then common equity, which is the capital that the sponsor would raise, is the last 15%. So just so you guys see, it should be pretty easy to see in a normal deal without pref equity. If we didn't have pref equity, if the bank's providing 65%, the sponsor has to go out and raise 35% of the remaining cost. 35% of 30 million is 10.5 million. In this scenario, the sponsor only has to raise 15% of 30 million, which is 4.5 million. So it's $6 million less. Now the $6 million less, as you will see, comes at a cost. Pref equity is more expensive than debt, but also has more protections for itself than your normal common equity. But I wanted to show the scenarios right here, even in a, sorry, my Siri watch just went off for some unknown reason. Even in a scenario where you're getting 75% debt and pref equity comes in at 10%, that still is reducing the amount of capital you need if that's the way you want to go. So like I said, this spreadsheet is going to expand. So I just kind of went through this a second ago, but now you can see real numbers. The capital raise is if the pref equity didn't exist. So in your scenarios, no matter what scenario you're in, if pref equity goes to 85%, you don't raise more than $4.5 million on your $30 million deal. Okay, and I'm talking generalizations. If there is no pref equity, you can see right here what your capital raises are. So even at a pretty good bank debt of 75%, which is going to be your top tier 1 markets, and your class B or C++ properties or better, you're still going to raise $3 million more if you don't have the 10% coming in. So now we go into the blended cost of capital. I promise you, I'm not going over how we calculate this. It's a very simple calculation, but this is not a math webinar. This is just to kind of show you the differences. So what I said earlier was we want to know what the blended cost of capital is. So the reason you use, one of the main reasons you use pref equity is it brings your average cost of capital down for the whole 30 million. In this scenario, if you have a 65, 20, 15, your blended cost of capital is 7.65% on the $30 million. Without the pref equity, it's almost 9%. That's a big difference. And you're probably saying, well, okay, what's 1.3%? I'm going to show you guys in a minute how that turns out. It's actually pretty significant. So even at the best rate, percentage-wise on bank debt, your blended rate is still 65 basis points better than your equity, and that translates into real dollars. The real dollars are going to show up next. Whoops, there we go. So this is where it starts to get a little interesting, especially for some of the sponsors that are on here. And so all I've done is added the last 2 columns right here. So savings and costs. Okay, this is for 1 year. I kind of had to squeeze the slide. So per year, savings and costs, basically this is interest or returns you don't have to pay out to if you had 30% common equity or 30% capital. So you would save $390,000 a year, which basically goes to your NOI, which means there's going to be $390,000 more to distribute to your private capital or your common equity and to the GP. If it's a 5-year hold, that's a pretty significant number. It's almost $2 million. Okay. Then if you have a typical 70% deal and you just split the remaining amount of capital, 15% pref, 15% common equity, you can see how it works right here. That's essentially going to translate into almost $1.5 million over the 5-year period that's going to go into the LPs and the GPs pocket. This is not taking into consideration any capital gains that are associated with an actual sale. This is just typically the cost of the asset during the entire period, because you have different pieces of capital you've used to hold on to this asset. And then even at a 75, 10, 15, okay, you're still almost at $1 million in extra NOI over a 5-year period. So how does that translate on a normal deal? Again, I apologize if the math is not making sense. I'm happy to send everybody a spreadsheet that actually has the calculations. So, Rob, I can't believe you put me in there. That's a bad picture of me. He's laughing. So here's how it actually translates. If you're doing a typical 80%, 20% deal, that 1.9 million, that translates to $1,560,000 more to the LP than if there was no preferred equity, okay? And it's about $390,000 more to the GP. And as you can see, the numbers drop off, obviously, because using less pref equity. These are real numbers. Now, there are 2 ways to look at this. You can look at this as, well, that's a lot more money that goes to the LPs or GPs. So now their IRR could be, 27, 28%, or Doug and Jeremy might argue, and I would agree with them, that it might also allow them to do a deal that otherwise didn't make sense, because by adding the 1.5 million right here, it now gets the private capital up to an 18 to 22% IRR. So we're seeing both scenarios play out, or at least I'm seeing both scenarios. On my gut, I see Doug nodding his head. He's seeing the same thing. So there are a couple different ways to look at this. You look at it as, okay, maybe I want to really juice up the returns for my LPs and for myself as a GP, or hey, I really like this deal, but man, the cap rate is really low. Cap rates are pretty low right now in DFW and parts of Houston, but they're great deals, and financing is relatively very cheap, excuse me, not even relative, it's very cheap. You put a piece of pref equity in the middle before your common equity, so now it makes your overall financing even less expensive, which makes these deals work. So again, we're going to save this towards the end and let Doug and Jeremy give some examples, but they're really 2, from what I've seen as a lawyer and then as an investor, I see 2 different ways in which pref equity could work. And I notice I'm saying could, not should. Not every deal is a good pref equity deal. And more importantly, not every pref equity fund does every deal. And Jeremy will speak to that. They're picky sometimes, and there are things that freak them out, and there are other things that don't freak them out. And they have to have the right relationship with the lender that's doing the underlying debt. If there's not a good relationship with the lender on the underlying debt, the lender's not going to approve pref equity, because there are provisions in the pref equity documents that give them certain rights over the GP, which we're going to go over in a minute, that the lender would have to sign off on. Finally, not a picture of me. So these are some typical terms. I have seen pref equity term sheets that are all over the board. Just like anything, just like debt sheets that you guys may see, especially from bridge lenders, they can range from good to all over the board. So in a high level, I would say about 75% of the pref equity term sheets I've seen kind of fall in this range. They're typically 3-year terms with options to extend either 2 years or 2 6-month periods. It depends on what you've negotiated, but typically they have a couple options to extend. They are interest only. I say interest only because it's not debt, but they're like interest only. The interest is obviously the pref. They do charge a point. I don't want to call it an origination point, because then that's like calling it debt, but it's the same thing as you would see on a mezz piece. It's an origination point. Most are in the 1 to 1.5 points. I have seen some 3 points, but the ones I saw that were 3 points were deals that were not cookie cutter deals. There may have been some hair on the deal, or there may have been some hair on the one or two of the sponsors or co-GPs, so they deem it higher risk. So they're going to make it more expensive. Same thing with the amount of pref they're going to charge, whether it's 12% or 18%. Now, here's where those of you that are sponsors or going to be sponsors and are looking at this will find this very interesting, because initially when I first saw this, 12 to 18% made me really nervous. It kind of made me think, well, how am I ever going to get my capital paid? If they're taking the first 12 to 18%, on half of the capital that's raised, essentially, I don't know if I'm going to get my capital paid till the very end, and there's no way capital will stay with me if they're not getting any cash flow. So the pref equity firms are very aware of this, and at least my experience with them, their goal is to work hand in hand with the lender and with the sponsor so that it works out right. So, and again, I will defer to probably Jeremy on this later if he's seen some different examples. But again, about 75% of the deals that we've seen, as you guys know, in syndications, your waterfall basically is cash flow is distributed this way, and proceeds from a sale or refi may be distributed this way. Typically, they're an 80-20 split, unless there's a preference that goes to the capital. So this is how it works in a pref equity deal. The ones we've seen, typically you have between 7 and 8% of cash flow, or not of cash flow, but pref equity gets 7 to 8% return before any of the remaining amount is distributed. So if you're doing a quarterly distribution, if pref equity gets their pro rata of the quarterly 7 to 8% of the 7 to 8% quarterly, the remaining cash goes to the fund, the syndication fund, and that's distributed no matter how the waterfall is, 80-20, 75-25, 90-10, it doesn't matter. They're only taking 7 to 8%. Sometimes it's 6.5, but most are sitting around 7 to 8 of whatever the total prep, like you see up here, maybe it's 13.5 or 14. That remaining amount is deferred till a sale or sale or refi. So it gets paid in the proceeds. So you'll see right here, cash flow from a sale or refi. So the way the waterfall typically works is first to get paid will be all the accrued and unpaid preference to preferred equity. So in this scenario, if we were paying 7% to preferred equity and it was called a 14% deal, that 7% that accrued each year for 5 years gets paid first to your preferred equity. Once that's filled up, okay, then they're going to get 100% of their initial capital. So if they had their 15%, they get 100% of their initial capital, they're gone, okay? They're gone. The remaining amount on the sale or proceed goes to the rest of the fund. So once you've paid off your pref equity in 5 years, or maybe it was 3 and you did a refi, they're out of the deal. So they don't share unless there's some major default provision that was written into their documents. They don't share on the back end. Okay, so they're gone for the most part in this type of scenario. As a lawyer, I'm telling you, there are exceptions to everything. But again, these are the general terms we see. Additional pref equity terms, okay? So they have a redemption right. They have a right to redeem at 100% of the capital and total pref. What does that mean? If, I'm sorry, not they, the sponsor has a right to redeem. So let's say the sponsor is going to refi in 2 years, okay? And the term is 3. They'll let you get out. The penalty is they're going to get their preferred interest for the term of the preferred equity regardless. So if you've paid them 2 years at 7% a year, they're still going to get 3 years at 14% when they close. The difference is they're out of the deal. So most of these, not all of them, most of them are written this way. If the sponsor defaults under the loan they have with the debt, pref equity has the right to cure, but not the obligation. Notice these are rights and not obligations. They don't have to cure, but they have the right to cure. Typically, they have the right, and some of them actually have the obligation to approve major events. Major events would be a refi would be, and they're typically defined in the pref equity documents or the company agreement in the pref equity company agreement, but it could also be expending CapEx of more than $500,000 or $100,000. It just depends on the pref equity group. They have the right to remove a sponsor. You need to know this. You need to make sure your lawyers, whoever they are, if they're not us, you need to make sure your lawyers are looking at this language. There's not a whole lot of wiggle room with them on these, just like it is with the lender when you're looking at lender docs. So you need to make sure that you're looking for this type of language. It's very similar language that you'll see in most of your loan docs. If there is a major default and the time to cure the default has passed, the lender can remove the manager. Doesn't mean the lender is going to. Just like here, the sponsor can be removed by pref equity. And that's why I was saying earlier on that pref equity and the lender have to have, they typically have an agreement, a written agreement that allows pref equity to do this. What you guys may not know is the lender actually does due diligence on the pref equity fund as well. So if the lender is allowing the pref equity group the ability to come in and remove the sponsor if the deal is going really south, the lender wants to know that the pref equity group has the experience and the ability to run the deal. So, and I don't know if Jeremy or Doug get into that aspect with the pref equity groups, but I've seen this in most of the documents and talked to a couple of pref equity groups. And what we've also seen is there are times where the sponsor may be removed, but they don't lose their interest, their economic interest, but it does trigger a default provision under the pref equity agreement. And so most of these default provisions typically will be 20 to 24% preferred interest, preferred return, excuse me, versus the 12 to 18. It'll be very specific in the document. And these defaults are normal defaults that you would see in lender stocks. And they have, in my understanding, in my review of the documents, normal cure periods, but sponsors need to be aware this is not regular capital. This is more like debt without having any security interest in the asset. So if you're screwing up and not paying the lender, you run the risk of screwing up and being removed by the sponsor. So again, these are things to keep in mind. And as you get really excited about pref equity, I'm not trying to be Debbie Downer, but I'm the former corporate bankruptcy lawyer, and I've seen everything go to hell in a handbasket very easily. So we try, and Cindy and Greg try to point these out. I don't think I have it in here. Oh yeah, I do have it in here. So here's some more things to look out for. You don't really have to look out for this, but the due diligence for a pref equity fund is pretty much the same as it is for the lender. So if you're coming in after the lender has performed due diligence or while the lender is performing due diligence, typically the sponsor can simply provide most of that due diligence they provided to the lender to the pref equity. So it does make it a little bit easier for the pref equity. Almost every pref equity deal I've seen has a due diligence fee. They can be anywhere from $10,000 to $25,000 because they still are going to go through and do all the things the lender would do to check all the boxes. And this is something that Jeremy and Doug can speak to, but from what we've seen, most pref equity funds that we're involved with typically are providing 5 million or more in deals. I've seen a couple deals where they're like 4.2, 4.3, but typically it's 5 million, and the larger ones, they really want to be 10 million or higher. It's kind of sad for us to do smaller deals than institution, but in their mind, 5 million is a lot to worry about for a small return. Because they do the same amount of work on a $20 million pref equity infusion as they do on a $3 million. So as Jeff likes to point out, it's called ROE, return on effort. And the effort's the same, so they're gonna want a bigger return. They're typically gonna require 10 to 20% by the sponsor. And that's not for you guys to freak out thinking you've got to put 20% of 30 million. That means they expect the sponsor to come in and raise 10 to 20% of the capital. I use 15% in the in the example. And as we just said before, punitive default provisions. They're punitive in the essence that they pretty much mirror most of the lender default provisions we've seen. Again, if you're going to use pref equity, most of these will be outlined in their term sheet. Pref equity's term sheet's typically going to be like a 4 or 5 page term sheet. Most of them will outline them. If not, ask for a sample set of docs. Get your lawyer to get them. They'll send over a sample set of docs too, to give you a heads up. They don't want you to have any surprises at the end either, because they're earmarking this money to go into the deal. 3 to 5 year exit strategy. Typically, it mirrors, I put PE terms, it mirrors actually the lender's terms. So pref equity is used a lot with bridge, especially now that many of the bridge loans are way down. I've seen some at like 3.5, 3.7, some even a little bit lower, but typically they align with the same terms of bridge. So bridge may have maybe a 3-year bridge with 2 1-year options, interest only. So you may see pref that's working with that bridge or has worked with that bridge, and they will align their terms 3 years, same option period, blah, blah, blah. There is a purchase obligation at the end. So this is where it's almost like a loan, but again, it's not securing the asset. The obligation is the sponsors. The sponsors have to purchase or pay off the pref equity at the end. So it's almost like a put, for those of you that are familiar with puts. So it's almost like a put on this, where they're basically putting it to the sponsor. You pay for it. And what a couple of our sponsors and co-GPs didn't realize is that actually makes the pref equity at the end recourse. Okay, recourse meaning the sponsors are obligated to pay it off at the end if it's not paid off by the fund. So it is a non-recourse, it's not a loan, so there's no essential liability or obligation during the term of it, but if it's not paid at the end of the term, it can become recourse. Doesn't mean that pref equity wouldn't extend it. It's going to depend on the performance. It's going to depend on 100 different things. So I don't know if Doug or Jeremy have been involved in a pref equity deal that's gone beyond 5 years. I haven't, but it's going to depend on whether they really want the asset or not, or whether the sponsors have the ability to do it, or whether they just charge another point and get another 6-month extension because there's a sale that's pending or a refi that's pending. So these are terms that you just want to be aware of. Your law firm that you're using should tell you this. Another really bad picture of me. And again, these are just pros and cons. We kind of went over these before, because I'm kind of speeding through this a little bit because I want to get to Jeremy and Doug and go over some good questions. I see Doug laughing at the picture. Doug, one day you'll have gray hair. Trust me. Pros, these are quick funding. I'm going to put Jeremy on the spot. Jeremy said he can get every one of these funded in 30 days with no problem. You see him smiling. 30 days is probably the absolute quickest, and you're going to really piss off the pref equity fund because it's going to be a pain in the ass. 45 days is probably what they would consider quick funding. I think if you talk to most pref equity funds, they probably would like somewhere in the neighborhood of 60 days or more. My gut tells me you're going to get a little better terms too, the more time you give them to search out capital. It's a great alternative to raising capital, as we said earlier. It does reduce your average cost of capital, so it will make deals, or I shouldn't say it will, it could make deals better, or actually deals, by using pref equity, because it could make a 4 cap deal or a 4.2 cap deal work when you're adding pref equity versus trying to find a 4.7 or 4.8. And this is more of Doug's world when he's pushing this. Obviously, less capital raise. We've got clients, and we see on Facebook and other social media, sometimes it's not easy for people to raise capital. Sometimes everybody's fishing from the same pond, and there have been 10 or 15 deals that have been put out there, and capital is slow. And so here's a way, as we showed you earlier, you can take in one scenario where you would have to raise 10.5 million on a $30 million deal, assuming you got approved by pref equity. And all of a sudden, you only have to raise 4.5 million. That's a huge difference. That's 40% of your capital you initially had to raise. And again, reduce the cost of capital, which I said before. Cons. preferred return is in first position after the loan. So if you're an investor in the deal, you just have to know that there's a preferred return ahead of you. Now, some investors, and I've run into this, don't quite understand this and think it's a bad thing. But the reality is, more and more people, and we've done it on a couple of our own deals, do what's called a coupon class, which essentially is what pref equity is. But we've done deals where Class A is a coupon class. They have a 10% pref, which means they get paid 10%. They get their 10% before anybody else gets a distribution. It's actually a higher return up front than pref equity is, because they're typically splitting it, or they're only charging 7 or 8% up front, and the rest is upon a sale or a refi. So it's not a whole lot different than having a coupon class in front of you. They do need lender approval. You're not going to get pref equity in there unless the lender has signed off on it. And I did put, they have onerous control default provisions. Onerous meaning private capital, your normal private capital raise has virtually no control or default provisions. They need a super majority to remove the manager if something egregious is happening. And if it's that egregious, it doesn't matter what position you're in bad shape. It is short term. You're not going to find well, I have not seen a 7-year pref equity on a multifamily. It may be out there. I haven't seen it. The non-recourse can turn into recourse, which I said earlier, and you guys should know that that is joint and several liability. For those of you that don't know what joint and several liability is, I'm just going to pick names on the screen I see. So let's say Merrill, Rob, Doug, and Jeremy all are GPs, co-GPs in a deal, and we decide we can't pay the pref equity at the end of the deal. Well, they can go after that. Let's say it was 4.5 million in pref equity. They can go after Doug for all of the 4.5 million, because Doug makes tons of money as a broker, doing thousands of multifamily deals a year. So that's pocket change for him, but they can choose to go after one, all, or even none. So you just need to understand that as a co-GP or a GP that has other partners, that it's joint and several liability. And then pref equity will have their own underwriting requirements. They do. And Jeremy and Doug probably see the same things we do. And I know they've been on a couple of the deals. The underwriting requirements are very, very similar to that of the lender. They may ask for a few more documents, but they're very similar. And then why do investors invest in pref equity funds? So this is interesting, because why are pref equity funds becoming more and more popular? It's not that they're more popular. Mezz has always been there, mezz financing, but pref equity has been there for large institutions. And now they're coming down for non-institutional deals, our type of deals. $20 million, they're really not doing $20 million deals. 30 million is probably the lowest I've seen, maybe 28. But they're typically right now in the 28 plus deals. So if you are a private equity fund, why would you want to do a deal with one of us? Well, your return is ahead of private capital. Just like a coupon, you're going to get paid first. You have similar protections as debt, which private capital doesn't. So this minimizes your risk. So you're getting paid first, you minimize the risk. And here's the kicker. This is something that's very interesting to me. So preferred equity actually gets part of the bonus depreciation. Okay, they get it, but most of the deals we're finding, and Jeremy, Doug, and I were talking offline before this. Most preferred equity groups are not taking it, but they qualify for it because this is equity. It's not a debt. It is equity. It has debt-like terms, but it is still equity. And then why do preferred equity funds like it? It's a coupon. It's better than a bond. It's better than the stock market. It's getting paid before common equity, and it's got protection. So it doesn't make as much as common equity, but as everybody on here knows, it's a risk reward analysis. Either you're going to have high risk with much higher returns, or you're going to have lower risk with lower returns. This one kind of sits in the middle. So it could be a nice variation or a blending of your own investments. But that's why the pref equity funds have dipped down and really are looking at our types of deals. And people like Jeremy have developed really strong relationships with pref equity and the debt. So they're going to know which pref equity funds will work better with this type of debt, which we're going to go talk about in a minute. Whoops. And the minute is up. So I'm going to let Jeff unmute Doug and Jeremy and Cindy, and unmute yourself, Jeff. And we're going to go and do a couple of things. I'm going to repeat one more time. Any of you that came in late, if you like, feel free to put in your contact information. We already have your contact information, so it's not for us. For those of you that are reaching out and trying to build your own database in the old pre-COVID days, we used to have happy hours every month, and people got to meet and switch cards, and that was the first meeting, and then you have another one, or you have a call or whatever. So this is for your pre-existing business relationship for many of you that do 506Bs. So the point of doing that is if you're interested in somebody that does deals in Oklahoma or Alaska or Texas or whatever, or you want to say something about yourself with some contact information, it gives others the ability to reach out to you. And then if you have questions, type questions in the chat box, because I'm going to bring Doug and Jeremy. Jeff, you can unmute Jeremy. That'd be great. Or maybe Jeremy has to unmute himself. Look at that. Jeremy's still working. He's in his office. Let's see. So Jeff, you gonna make me go through all the questions?
Yeah, Greg has been answering some of them as we go along, so I'll.
So let's go back, Greg, and let Jeremy. You're still on mute. There you go. Let me first, before we get into questions. So, and I'm gonna reach out to Jeremy first. Jeremy, were the terms pretty typical to what you see in some of your negotiations with the PE funds?
Yeah, I would say so. And I think one thing to touch on kind of the history of where pref equities become more competitive is that historically existing deals, you'd see it almost be entirely current pay, with the accrual component of it being something that was typically found on development deals. But in an environment where these preferred equity groups are becoming or required to become more and more competitive, they've now structured these so much to where it's like a current pay on the front end with accrual on the back end. But at a high level, 18% I'd say would be extremely high. I think groups have been pushing on proceeds and pushing on rate as of recent. But at a high level, I think all that makes perfect sense the way you illustrated it earlier.
And real quick, so you mentioned current pay. I didn't use that term with anybody on here. So current pay is simply, that's the pref. I think in the example I had 7 to 8%. That's what Jeremy is referring to as current pay. Traditionally, it had been almost probably 12, 13%, and then a little piece on the back end when the deal sold. But as he said, one, the cost of funds has become much cheaper, and there are more groups out there wanting to do pref equity. So it's to our benefit as sponsors. And Doug, I'm going to ask you, are you seeing, I know the answer to this, so it's kind of a leading question, but are you seeing more and more sponsors asking or looking into pref equity recently or lately?
Yeah, I mean, they definitely are on the buy side. And what's interesting too is we'll see it sometimes on the sales side. We were working on a deal up in Oklahoma, and the seller, to help drive the pricing, said they would be open to leaving pref equity in the deal for a buyer, because obviously they know, because they're buyers too, that it can juice the returns, which can help push the pricing. So we're seeing it from both sides.
That's interesting. So that's basically
kind of like a seller carry, if you will.
Yeah, seller finance couched as pref equity. So you have now you have pref equity cheating and acting as mezz and owner finance.
Mm-hmm.
That's interesting. I didn't even think about that. I like that.
Yeah. Yeah.
So we have a question here. I was just going through. I know, Greg, are you on?
I am.
Okay. So Greg, if there were any questions you answered in the chat room, because I know not everybody's able to keep up with everything in the chat room, can you maybe list a couple of the questions that you answered?
Sure. So one of the questions, which you sort of answered already, was about the distinction between a coupon class and pref equity. and I think you answered already, but just to sort of reiterate, a coupon class is still from sort of your private investors that you would raise in your typical syndication. Pref equity is from almost like an institutional single investor that allows you to not have to raise as much money from all of your sort of typical syndication investors. But like Merrill said, goes along with when you have one investor, they're able to dictate the terms a lot more than the individuals in the group would.
Like having one wife versus 4 wives?
Something like that.
Okay.
Well, and it's just an easier process. So like what Merrill was saying earlier, if you have to go out and raise $10.5 million, but if you have one single check writer in a pref equity for $6 million of that, it's just a much easier process. So I think that's the biggest difference. You're dealing with one person, one check writer in a pref equity with an institutional investor or high net worth family office. I mean, Jeremy works with some different groups and on the JV equity side too. So we can bring, LP equity to the table with a single check writer. We're not broker dealer licensed, so we can't go out there and bring a bunch of investors to the table from the private capital space.
So another question.
Right, Doug.
Go ahead.
Oh, I was going to say on that too. Something to consider is kind of really identifying the strengths of the entity, the sponsorship entity, right? So we have some groups that love the capital raising component of their business, right? So to go out and raise $10 million through a variety of different investors is something that, they enjoy, they like. Others that want to leverage their operational efficiencies, that kind of running the assets day to day, it may be a bit more of a headache. So outside of just lowering the capital required to get the deal done, consider the time management component of freeing up a $10 million raise versus a $4.5 million raise. We talk to sponsors that love raising capital, others that hate it, think it's a waste of time. So really just the different angles of which looking at thinning out the capital required to close in some of these transactions and the different benefits from doing so.
And let me add to that. That's a great point, Jeremy. And here's another aspect that I'm just thinking about. So on a larger deal, let's say you've got a 2-asset deal that's $100 million and you're going to get 70% financing, which is $30 million that you have to raise. So either you're going to be able to raise $30 million or you're going to have to bring in 5 or 6 or 7, who knows how many co-GPs that may be helping you raise capital. So now you've got 8 cooks in the kitchen. And it's happening right now in many deals, which is good in plenty of deals, but you may also have cooks that you've never cooked with before and you don't want to set any fires. So aside from it, pref equity allowing you to, or giving you the ability to raise less capital, it may also give you the ability not to have to bring in more GPs that create more work potentially, not always, but potentially. So I've seen a couple clients that have foregone bringing in more GPs in exchange for pref equity. And while it creates less issues, pref equity, as we said earlier, still has more control mechanisms and default provisions, far more than you would private capital. But that's another reason why a couple of investors that I know, a couple sponsors, brought in pref equity. They just didn't want to bring any more GPs in, and they weren't able to raise, or they didn't want to stress raising the amount of capital in such a short period of time, especially when there are lots of deals out there at the same time. Greg, did you have another question? You were about to say something.
Yeah, another one for Doug and Jeremy. Can you pay out the PE through a supplemental instead of a refi?
Well, I mean, to me, they're kind of, a supplemental is sort of a form of a refi. So if it accomplishes that goal, if you can get enough proceeds, then yeah.
Yeah, so supplemental and a refi basically are saying the same thing.
Yeah.
It's just terminology. So yeah, listen, a refi may not pay out pref equity. It's going to be subject to what your proceeds are going to be, and sometimes a refi is simply a mechanism, sometimes just to get a lower interest rate. Right now, it's very difficult to refi current to get much lower to justify the expense of refining. But one of the things, and Jeremy, this probably is more towards you, and we've seen this, pref equity is not a done deal. They are still going to go and they are going to do a colonoscopy on the sponsors, because they need to know, one, the sponsor's ability to do the deal and to keep the deal. As a hard money lender for many years, you go into the deal, every hard money loan we would do, we looked at it and we said, okay, would I keep this property if I had to take it back? Would I have bought this property? If the answer is yes, then typically we would do a hard money loan on it. While pref equity should be in the position to take the property back, at least according to the bank they should be, my gut is telling me that pref equity does not want to take the property back. They try to price these and they do their risk analysis such that they don't have to take the property back. So in doing that, they're going to look at your underwriting. They're going to do their own underwriting, and they're going to look at the strength of the sponsors. Jeremy, are you seeing anything different than that?
Merrill, I completely agree. And I think it's something for maybe some of the more emerging manager profiles that may be on this call, that a lot of times when you're working with more, we call it institutional caliber capital, that it isn't always as real estate centric as you may think it is. And that if they're truly partnering alongside another entity, they want to have good faith and trust in their ability to execute that business plan. So you had mentioned leveraging co-GPs earlier. Oftentimes it's a great way to get your foot in the door with some more big check writers, is kind of leveraging the experience and the balance sheet at times of those who can really kind of help you expand the portfolio. And so considering the team that's at play, your ability to illustrate your track record and executing a similar business plan as the one that's at play for this hypothetical deal at question are all things that's going to really improve the narrative on that specific assignment.
Great. How about some more questions? Were there any more questions that you saw?
One was, do we know any pref equity for deals as little as 1 to 2 million?
Remember what I said about REO? It's Jeff's favorite term. That's how we analyze deals now. Return on effort. So if someone's got pref equity amount of 1 to 2 million, you might be able to find somebody. It's almost like a hard money lender that's willing not to take a secured interest in the deal. You're not going to find too many groups out there. You're better off finding a high net worth individual that wants to come in as a coupon class, which is what we talked about earlier. Jeremy, I don't know if you are able to place I'm assuming the deal is not 1 to 2 million. If the deal is 1 to 2 million, I'm going to respectfully say there are not any pref equity groups that I'm aware of that would do $150,000 or $300,000 pref equity piece.
Yeah, and as far as Merrill, that kind of universe of groups that can play there, I think bigger picture, similar to what we were just talking about too, kind of what the sponsor's trajectory looks like. Oftentimes groups may look at the opportunity to do a smaller deal if the intent is a bit of a programmatic style relationship, that the sum of the deals that could exist over the next 12 to 18 months would be significantly larger than that $1 million amount. But nonetheless, I would say that it's generally a very small bucket that would be able to compete in that range. It's, as Merrill was saying earlier, it's going to be probably 5 million and up, and even 5 million is relatively small. But it's deal by deal basis, right? But I'd say, Merrill, you're thinking about it the right way with that answer.
Yeah. So what Jeremy said, we can. They introduce a lot of programmatic partners. So even if maybe on a deal it's on the small side, if there's going to be a number of deals lined up for the next 12, 24, 36 months, they might go lower on that particular deal.
Yeah. And from past experience, again, as a lender, if we were pref equity, I would imagine on the smaller deals that require more effort, we're going to charge more on a pro rata basis. So you're probably not going to get a 12 or 14%. You may get 2 points or 3 points instead of 1, because 3 points on $1 million is a lot less than 1 point on $5 million. So And again, I agree with Doug, because we've actually seen it where a client got 4 million on the first one and prep equity was bitching the whole time. You know, we really want more, really want more, but the sponsor said you can go more, but the pref equity wouldn't go above 85%. So, you know, and you really don't want to. Here's the other thing: you don't really want to decrease your debt that's at 3% below what they're offering you. I mean, there may be situations where it might make sense only because you don't want to raise the capital, but you're still going to raise that back 15%. So getting debt to go from 75 to 65, that's only hurting you, to be honest. Now, it might get you a better interest rate. In many cases, 75 in certain markets, you're going to trade rate, you're going to trade IO. So there may be some scenarios where dropping the debt amount from 75 to 67 or 68 or even 70 buys you 2 more years of IO, where in that case, it does make sense to trade some 14% pref equity for that 5% decrease because you're getting 2 more years of IO. And that's where you guys get to, that's actually where Jeremy gets to have a lot of fun and go back and forth with clients on literally it's like making wine. You are just blending and blending and blending. And the hope is that you don't blend yourself out of a deal, because you have to keep in mind pref equity, these are small amounts for pref equity funds. So their patience level is going to be only so much until some easier deal hits their books and boom, you know what? We're going to pass on it, but I appreciate it, guys. So we've seen it on a couple deals. I don't know if Jeremy's seen it. Of course, Jeremy, you're going to say every deal gets approved.
Well, that much is true. But besides that, I think you covered it well. Just really painting a picture of the different nuances of the way this works. Obviously, the presentation covers this at a high level, but there's ebbs and flows and malleability to the way these groups are underwriting deals and willing to issue term sheets. So to say that there's a cut and dry way that each deal is done, we'd be lying to the group. But at a high level, all these points are correct. But you know, coordinating it alongside the senior and what the business plan looks like, et cetera, all things that come to mind, and all things that are very are offered with optionality for getting these things across the finish line.
Listen, and similar.
Go ahead, Doug.
I was just going to say, similar to in your presentation, you mentioned they're going to have their own underwriting. They're going to have different DSCR constraints, right? So they're going to see how far up the capital stack they're going and what the DSCR looks like with their pref equity at the rate that they're putting out there to kind of see if it covers. So not every deal is going to work, because most deals aren't going to be able to pay a 12 to 14% current. But like Jeremy was saying, there's a lot of pref equity now that's out there that's willing to accrue. But historically, that was mainly on development deals. So Jeremy and TC, they work with a lot of developers, and naturally for the first couple of years, all of that pref equity is accruing because there is no cash flow. It's being built. But they're starting to really get aggressive on existing deals, and there's so much capital out there that needs to be put out.
Yeah, that's kind of where I met Jeremy, was on a development deal we're working on. And yeah, I mean, from a high level, development deals, value add deals, pref equity really likes. But as you guys are saying, they're doing all sorts of deals right now because there is a lot of capital out there. There was a good question I was going to ask, and I can't remember what it was.
We had a couple of people ask a similar question. How do we find and meet these pref equity funds?
Well, that's what I was going to say. Thank you, Jeff, because that actually goes into the question. So one of the things I do that I'm sure annoys Doug, and I hope I'm not the only one, Doug will send out a deal, and we all go, hey, what's the whisper price? Even though it's not really a whisper price. And then typically the first thing I'll ask Doug, and I'm sure others do, is, hey, do you have, not really a term sheet, but do you have numbers from a lender that's looked at this deal already? Because we want to get an idea. We kind of know, but sometimes lenders are a little squirrely. Sometimes there's some history on the property or near the property. So one of the recommendations and Cindy and Greg and I have been making to some people that are out there getting new deals is, when you're talking to these brokers, especially like Greysteel and a couple others, but we're only talking with Greysteel today, they can go and run pref equity up the flagpole at the same time. I'm telling you guys, if it's something you want to see, why would you not at least have Jeremy or someone in Doug's office at least ask about it? Because then you could get an idea before you start your capital raise, how many people am I going to have in this deal? How much capital do I have to raise? Does pref equity like the deal? Or does pref equity think I'm a nobody? I could be someone who's done 38 deals and they love me and no big deal. And Jeremy, I don't know how many people are coming to you early on, but if it were me, I like to have options. I always like to have options. I like to have multiple exit strategies, I like to have options. So I would love to know if I'm going to go find a $45 million deal. Let's say I'm looking at a $48 million deal in Houston right now, hypothetically. And I have to raise 15%. If I want pref equity to cover that up to 85%, I'm either going to raise 30% on 48 million plus there's CapEx, but I'm not even counting CapEx. That's going to be 14.4 million. So I'm either going to have to raise 14.4 million or 7.2 million. I'd like to know ahead of time, are there pref equity groups interested in doing a deal with me before I have to go out and start my campaign? That could be the difference between, do I need to go grab some co-GPs as I'm doing this deal and moving forward, or hey, I got this under LOI, this is what I'm looking at. So that's where I think it's really important to rely on guys like you, Doug, because you're not only finding the property, and obviously you represent on the sales side too, but you're not only finding the property, you're also helping with the capital stack. And what people don't understand is you're just incentivized to help people get their capital stack done. Obviously you don't do the private capital because you're not broker dealer, but you're not getting paid if the deal doesn't close. And
Exactly.
so you're incentivized, you're their friend. Yeah, I don't know, maybe you make a point, half point, I don't really care. You're finding cheaper capital. So my recommendation, and Jeremy's probably going to hate me for saying it, but all 200 and whatever 60 people that register for this, they all should reach out to Doug and Jeremy on every deal. And, not every deal, but on deals. And at a minimum, I'm confident that Jeremy can give you ballparks without having to spend too much time. If pref equity likes this deal, this is what you're kind of looking at right now. Because the playing field changes. Right now it's changing for the better day by day, but the playing field changes. And I've seen this, I know you have, Jeremy, where you'll have a pref equity group, and there was one out of Houston, some clients are working with, all of a sudden they were full. They had all their allocations for Houston, they were done. And we were working on a deal with a different pref equity. And unfortunately, this Houston deal had much better terms, just random email. Hey, do you have any clients that are looking for pref equity? We just got some more capital in. So it's constantly changing. But again, these guys can give you some heads up. I mean, they're really part of your team. And I don't get a dime for referring Doug or Jeremy. They're good professionals. And I've known Doug for a while, and Jeremy has had some really good conversation with us on a development project. And we have more and more clients using pref equity. So I really think at a minimum, you guys should start exploring it in the right deal. If you're having issues raising capital, or you see a deal that's really good, but because of the purchase price, it's not penciling in. And again, pref equity will help you. They'll help you decide, especially if you get them involved earlier, this is a good deal or not a good deal. So before you go even harder on money or more hard on money, get a 50,000 foot, answer on whether pref equity likes the deal. Because look, if pref equity doesn't like the deal and the deal's too skinny without it, you need to walk from the deal. It's not going to be a deal. So anyway, Greg, any more questions? Jeff?
If I could quickly interject, Jeremy, Doug, could I ask you to put your contact information in the chat box? We have people that are interested.
Yeah, and yeah, I said this at the beginning, and some people came on at the end. We do this on every webinar. So those of you that haven't been on one of our webinars, monthly webinars, we will send a copy of this webinar to every person that registered. And so we will also include the contact information for anybody that was speaking on the webinar. So Jeremy and Doug will give Jeff his contact information, their contact information anyway. and Jeff will send this out to everybody with a link to the recorded webinar. But yeah, please put it in the interim. So that way we like people to be able to focus versus having to write things down and type things up. Greg, did you see any other questions?
I think that was it.
Anybody, if you have any questions, put them in now. I know everybody is really excited to go party and drink Star Wars juice, if there's such a thing.
Watch all 6 movies.
Oh my God, it's like my son doing that. Yeah, I'm. So it's really funny. So Rob, who is the most, I'll just leave you with this. Rob is the most creative guy I know, and normally is just spot on. Like we'll go head to head, and just it's like vomit of the brain, no filter. And so we're always joking around, and I've got a little bit of right side brain, just a little. I said last week, I said, hey, I want to do a webinar on preferred equity because we have a lot of people doing it. I want to see if I can get Greysteel to come on. And I'm like, it'd be awesome to do it on May 4th. And Jeff's sitting right there, and Jeff is a geek. And Rob's like, yeah, that's cool. I'm like, yeah, let's do it on May 4th. Is there anything special about it? He's like, well, it's the day before Cinco de Mayo. I'm like, anything special about it? He's like, I don't know, man. I'm just not feeling it. What are you talking? I'm like, dude, May the 4th be with you. He's like, oh yeah. So this is funny. Rob was working on, we have a consulting business where we do marketing and help prepare investor decks and other things for all different types of businesses. He had just finished filming a bunch of footage, about 5 hours with this owner, and we're creating these little things that'll go out on social media. And he was like dead set on working on it for like the next day and a half. I sure hope none of them are on here. And when I mentioned to Rob May the 4th, I'm like, Rob, you can have fun with my PowerPoint with Star Wars. I don't think he did anything the rest of the day except focus on Star Wars, all the little things we're pushing out. Like it made his day. Now, the funny thing is, I did the PowerPoint this weekend. Rob's laughing. I went ahead and just did the PowerPoint, and I will take credit. I did about 98% of it, right?
You did good.
Yeah. So Rob gets it, and it was two-sided. One was, man, that's awesome. I can't believe you did it. And the other side was, oh, you actually did a lot of it already. So where you see my face and Doug's face kind of superimposed over famous people, that's Rob. 100% Rob. And he wanted to go much, much, much farther than that, but I'm not 100% sure on Doug's sense of humor, and I definitely don't know Jeremy's. So we tried to protect the innocent and not go crazy. Again, I don't see really any more questions. I really appreciate you guys being on the webinar. If you have questions, feel free to email us at info@kaliserlaw.com or team@kaliserlaw.com. We have Doug and Jeremy's information in. We're going to send you guys out a link tomorrow morning. And again, if you're looking at deals, I definitely would reach out to these guys or somebody that has contacts with Pref Equity, because it makes a difference. If Pref Equity is interested and you're comfortable with their terms, it's a great alternative to having to go out and raise capital. If either you don't want to raise capital, you have a hard time doing it, or the group you're raising from is full right now and they're empty. If they were full, it wouldn't be a problem, but are empty right now. So again, thank you everybody for being on, and enjoy the rest of your Star Wars day.